Welcome back to another episode of the SEI Mortgage Podcast. I'm your host, Ryan Marks, and today we're going to cover the costs associated when purchasing or refinancing a property using the DSCR loan or the Debt Service Coverage Ratio loan. I chose the DSCR loan product to go over the closing costs because this is one of the more popular loans, and it's great, again, for investors looking to build your real estate portfolio if you're looking to utilize a very limited income documentation process. But it's important to note that the closing costs that we're going to discuss today are typical with any traditional loan for that matter as well. So whether you're going conventional, a full documentation loan, or you're using some of these great, limited documentation products like the bank standard loan or the DSCR loan, the closing costs are going to be mirrored very similar. And more importantly, all lenders and financial institutions have to use the same type of document, closing disclosure, when conveying these costs associated with your loan and a loan estimate at the beginning of the process. So we're going to do a share screen here. For those of you listening, you can check out the actual video on the YouTube channel that we have, but we'll kind of go through all of the most important closing costs that you need to be aware of and some of the things that you need to be mindful of when you're buying a property. So the document that we're looking at is a closing disclosure, which you're going to receive at the end of the process when you've gone through all your loan approval, you've gotten your appraisal, you've provided whatever documentation is needed, and you're essentially going to be signing loan docs. This document's going to be included with your loan package that you're signing with the notary. So I chose the closing disclosure instead of using the loan estimate, which you receive at the beginning of the process, because that's essentially an estimate, and those are not final figures. So for our intents and purposes, I took out, all of the sensitive information, but on the top here, this is where you would have, your property address and your information and, some of the other financing pieces. So as we move down the document, you can see here that for this particular closing disclosure, this person purchased a property for $785,000. and they put just over 20% down. So a loan amount of $621,000 is a little more than a 20% down payment. But on the DSCR loans, you can actually go as low as a 15% down payment as long as the property debt coverage is. So typically a 20% down payment is the common payment, and that's what's, majority of these loan products use in order to receive like the best rate and terms and things of that nature. But then as you move down the document, it's going to go through, a lot of these specifics that you want to know about this loan product that, to back up what your loan officer conveyed, meaning, is there a balloon payment on this? Is it a fully amortized loan? Does it have taxes and insurance? So one thing worth pointing out is on the conventional qualified mortgage space, you can't actually have a prepayment penalty on any of their loan products. However, on the DSCR loan product, you do have the ability to go, with a 1 year all the way up to a 5-year prepayment penalty. So we covered that previously, but there are, situations where it makes sense to add a prepayment penalty on there, whether it's for, a 1, 3 or 5 year term, because it's giving you a lower interest rate, which is going to provide you with more positive cash flow. And then, in addition to that, typically when you refinance the loan, when interest rates drop, remember, you have to take into consideration there's closing costs associated. So they're not as much as when you're buying a property, as it pertains to the title and escrow piece, but those parties are still required to facilitate, when you're lowering your interest rate through a refinance. So we're going to move down further in the page past the payment information to go over, how these closing costs are broken down. So once you get to the cost at closing section, you'll see that there's technically 3 buckets here. When it says includes plus loan costs plus in other costs and any lender credits, it may seem like a very high number initially when you're looking at it, but it's important that, your loan officer breaks this down for you. So in that first bucket, when it says includes, for this example, $5,023.42 in loan costs, those are typically your standard one-time transactional costs. So those are like, the cost for your appraisal, the cost for the processor, the underwriter, title escrow, the people that are facilitating the transaction from the start, and then there's no more costs associated because your loan is closed, it's completed, you're in your home or it's rented or whatever the situation may be. And then the second bucket is those are still considered costs, but they're considered like reoccurring costs. So those would be, if you're impounding a mortgage for taxes and insurance, you have to bring those funds in to start. So typically, for example, you have to pay your homeowner's insurance, the annual premium, upfront for the first year. So even if you're not impounding, the lender is always going to require you to pay your first year's homeowner's insurance premium for that particular property. And then subsequently moving forward, even if your mortgage payment is covering a portion of that in your total monthly payment, you're bringing that cost in up front, in addition with the taxes as well. So if you're impounding your property taxes, that is a cost, right? That's coming out of your pocket. You have to, provide those funds at closing. It's not necessarily tied to the transaction itself. And then finally, the third bucket is that's where if you're receiving any credit. So whether those are, lender credits towards the loan product that you went with, or maybe you're receiving, seller credits that you negotiated up front or, after your home inspection in the process. So let's break down kind of where you can find those. So in buckets A and B under loan cost, this is where the lender section is located. So aside from, your standard, processing and underwriting fee, your cost for your credit report, like a few other basic items, they also put the cost of the appraisal fee in there as well. So even though the lender or bank doesn't actually work directly with the appraiser, that cost is still considered a lender cost. So you'll look for that, which is located in sections A and B. And then if you've ever paid these costs up front, so typically, again, you pay your appraisal fee as out of pocket. Well, you'll see that on the, paid before closing tab. So for this particular example, the appraisal cost is $495, but that person paid that fee up front. So we moved it over to the right side to show that, hey, that fee did exist, but it's already been paid for. And all the fees on the left-hand side of the column have not been paid for yet. And then once you move down the document further in section C, that's where you're going to see all your title and escrow costs. So these are, again, these are the parties that are helping to facilitate this transaction from start to finish. And when you're purchasing a property, that's going to be the seller's choice who chooses who you're going to have to work with for those fees. So you want to keep in mind that, unfortunately, you don't really have much control over that title and escrow piece unless you're refinancing the loan and you have access to your own title or escrow, contact. You can utilize them during a refinance if you're lowering your interest rate or you're taking cash out on the property. But for this particular example, these title and escrow fees were set by who the seller wanted to use to facilitate the transaction. So then finally, we're going to move into section F, which is prepaid. So this is where, again, when you're in that second bucket of those recurring fees, for this particular loan, they did not impound their insurance, they just impounded their taxes. So you can see they've set aside 6 months property taxes up front that they had to pay. And the reason why it was 6 months, even though this person is making a property tax payment or a portion of their mortgage payment helps cover the property taxes. So when they're due during different times throughout the year, the servicer is paying those on their behalf. They had to have funds up front. And here's the reason why on this particular loan. Because the property taxes were coming up due for that installment, and when you close on a loan, you don't make your very first payment until you're 30 days into your loan. So for example, if you close your loan in January, you didn't make a payment in February and your first payment was due in March. Well, if taxes are due in March or April and you need 6 months of impounds and you haven't even made a payment yet, you're obviously going to be short to pay the county, or the servicer for that matter is going to be short. So in this particular example, that was exactly the case. So we had to set aside a full 6 months property taxes so that way those can immediately get paid because they now own the property and it's their responsibility. And then aside from that, again, when you're paying your first year's homeowner's insurance premium up front, the only thing you're going to deduct from that then is any lender credit. So those credits are going to be located on section J, right? So that's where, depending on this particular loan program, it actually came with lender credit. So even at that interest rate of 6.625%, this person received lender credits to help offset some of those costs associated with the transaction. And that's what's giving them their final net number of what was due at closing. So in this particular situation, they had overpaid. So they actually received a credit back after the funding and closing of the loan, for the amount that's listed in the cash to close under to borrower section versus from borrower. But typically, you're always going to have, when you're purchasing a property, there's going to be funds due at closing. So the important thing is that you understand when you're looking at a closing disclosure document or understanding how closing costs work are aside from your typical down payment of 20, 30, 40, 50%, whatever you're putting down, you have to account for the closing costs involved within the transaction in that first bucket. And the second bucket, which is the recurring payments or, any prepaid interest on the loan, those numbers added together obviously are going to exceed what your standard down payment is for the property that you're purchasing. And you want to make sure that you have those funds available. And secondly, if your loan program requires reserves. So this particular loan program, as part of the financing or qualifications to it, this client had to have 6 months in reserves for this particular property. So if their payment, their total payment was $3,976 and change, they had to have 6 months payments had to exist somewhere, meaning, retirement or in their bank account, available actual assets that weren't like other equity in another property in order to qualify for that interest rate in those terms. So you have to make sure that if you're purchasing a property, aside from your down payment, you have to account for your closing costs and any additional reserves that you may need to have access to show for qualifying purposes. So that's pretty much the essentials of closing costs explained utilizing a DSCR loan. And again, remember the importance is, aside from the traditional down payment, remember that you have to account for the closing costs associated with the transaction, any potential reoccurring costs that you're paying up front, your prepaid interest before you make your first payment, minus any of the credits that you're receiving on the transaction. And for other great tools and resources, feel free to head over to SEIMortgage.com, where you can also get in touch with us. Until then, we appreciate you being a part of the community, and remember to let your income work smarter, not harder. We'll see you on the next one.